I'm John Vance, president and founder of Vance Wealth. Thank you for joining us today. We are going to be covering our annual market and economic update. So it's 2025. I've been now doing this for over 20 years. This is one of my favorite topics to cover because it allows us to reflect on the year prior and really look at the year ahead to help us decide what we need to do as investors to make better decisions. So we're going to cover a lot of topics today. Here are just some disclosures from our firm. One of the things that's really important to know is that this is not investment advice, and then anything that we discuss today, please talk to us as your advisor or to your tax professional if we get in any tax-related issues. So our agenda for today. So we're going to do a 2024 markets in review. We're then going to dig into some of the current economic data. We'll discuss some investment ideas and themes. And then we'll do 2025 key themes. And then we'll end on a note of be optimistic, focus on what you can control. So there's a lot of topics. This definitely is one of the videos that we do that involves a fair amount of technical slides. I will do my best to go through these topics one by one. There's a lot of good stuff here, and I want to make sure that we share our insights so that it makes you a better investor, or at least have a better understanding of what we do for you on a day-to-day basis. So current market update. So we're going to do a review of 2024. So this is just the Fortune magazine headline for 2024. And just really looking at Investor Guide, there's a big theme of artificial intelligence this past year. So we're going to dig in and see if this was a year dominated by technology. So U.S. stocks had a great year in 2024. So when you look at all this data on here and you look at the very bottom, it really focuses on a bear year, which is on the left-hand side represented by red, which is down more than 20%. And then you have a great year, which is on the right-hand side, which is over 20%. The fascinating things is that, the stocks do average 10.4% going back since 1926. Almost 100 years now we have that data. But you rarely get the returns around 10%, near their average on any calendar year. So if you look at that, the average return is represented by the pink, and that's only happened 6% of the time. So the reality is that we had a great year, which is the most common thing that we see. And then the question is, can we repeat this? Is this going to happen again? And historically, when we've had one of these great years, returns the following year have actually been quite good. So that's a case for optimism right there. There's definitely this idea that investors are having S&P envy. So when we talk about S&P envy, it's this idea of, well, why don't I just buy the S&P 500? Why do I need more broad diversification? Because frankly, the S&P has beaten everything over the last 10 years. And the short answer is you're correct. That is something that has happened in the markets. When we go back 20 years, 30 years, 40 years, there's definitely a case for diversification, and we're going to discuss that a little bit later today. But what we're looking at here is basically that 2024 was the 18th largest year for S&P envy, which means when you looked at a U.S. stock portfolio, as represented by the S&P 500, and a 60-40 portfolio, which would be a stock and bond portfolio mix. So you can see on the left-hand side, we've now had 2 years in a row where U.S. stocks did quite well, and then a balanced portfolio, still double digits, still great returns, but people are left with this feeling of S&P envy. Why don't I just do this? Why do I need diversification? And I'm going to make the case of why diversification is so important. The other thing that we looked at in 2024 was looking at global equity returns. So you can see this is definitely more focused on the entire world. It was still driven by U.S. large caps, which again is the S&P 500, up 25%. And then you can see all the other indexes that we're looking at. The MSCI ACWI, which is all cap world index, was up around 17.5%. One of the interesting dynamics when we see this is that, that in and of itself, the yellow on there is a great return for, in any market. But when the S&P has done super well, then you kind of feel like, well, why do I want to diversify into these other areas that I don't really understand? And maybe, I can't get my arms around why I would invest there. And so you can see U.S. small caps only up 11.5, still double-digit returns, but relative to what's out there, that was a weak part of the markets last year. And Really what's driving this, and you'll see this theme throughout our presentation today, is that Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla were really the big drivers of all the returns. So we'll have a lot of data in here. That's what this is known as the Magnificent Seven, or the Mag 7, and these are the stocks that are really driving the returns. Now, when we look at 1 year and 3 year data, there's a lot on this chart. When we look at this data here, we look at 1 year and 3 years. So these boxes are known as Morningstar style boxes. And you have value, core, and growth. And then at the top, it goes large, mid, and small. So what you can see is that the 1 year returns were definitely driven by large cap growth, up over 33% on a 1 year. And as you look over on the right-hand side, you can see large cap growth was up 10.47 on a 3-year average annualized return. And then you compare that to, let's say, the bottom left corner, which is small value, which over 1 year was about 8%, and over 3 years only averaged around 1.9%. And then when we look down at the bottom, it just shows the U.S. versus international markets, emerging markets on a 1 year and a 3 year. And you can look at how low the returns are, emerging markets and international, especially when looking at a 3 year. So one of the questions we get a lot, outside of just diversification is, are the markets overvalued? Where should I be investing? And one of the things that this tells me is that, yeah, the U.S. is getting closer to being expensive. There is some great value in other parts of the markets, like small companies, like emerging markets, like international. But it's like anything, these trends could continue for, more years, just depending on the fundamentals of the economy. So this is a slide that's put out by Goldman Sachs. There's basically a researcher, Shiller, has an index called the Shiller-Cape ratio, and basically just shows valuation. So on here, this does make the case that the equity markets are overvalued, or I should say, let me reframe that there. They have an elevated valuation, and you can see periods in the past, what we call post 1992, what's been the average. So we're definitely extended there. But the reality is, most of the time when we see these high valuations, it's because expectations of the future are high. With all the changes that are happening in AI, all the build out there, the automation that's occurring, electric vehicle build out, the change in the electricity grid, all the advancements that are happening in biotech and healthcare, there's a lot of reasons to be bullish, which when people are more bullish and there's greater opportunity in the future, you tend to have elevated valuations. Doesn't always mean it's a bad thing. However, we have to be mindful of that as investors. And I think it's very popular to just be long or bullish on the US markets, especially the technology companies, but it's really, really important to maintain diversification, because if you just focus on what's been doing well in the last 5 or 10 years, oftentimes that doesn't serve you well as an investor on a go-forward basis. When we look at, there's a lot here, but actually this chart is quite simple. So forecasting the market is complex, but doing the math is simple. So what this basically shows is that when you plot the unemployment rate of our U.S. economy on the bottom, on the x-axis, and on the y-axis, you plot PE ratios, or price to earnings ratios. So basically it's trying to look at how expensive are the markets and where's the current unemployment rate. So you can see we have this star. That's where we are today. Now, when this has happened in the past, that tended to mean that over the next 5 years, that forward returns have only averaged around 4 to 5%. And so I think that's a lot of investors' concern, is that, okay, we've had really strong gains the last couple of years. Are all the returns baked in? And potentially there is definitely some more elevated risk because of this. And historically, this does show that we're going to have lower returns over the next 5 years than we've had over the last 5 or 10. But that's normal with the markets, right? When markets are hitting all-time high, that generally means that returns have been good. But how that plays out over the next 5 or so years is really important. There's a lot of data points on here, but basically one of the things that is consistent is that when you go to the lower part of the on this chart where valuations are low, you see a lot of green dots. And when you have a lot of those green dots, that represents when markets were averaged over 15% on a forward-looking basis. So this just tells us that we should our returns potentially will be muted. But also we have to make sure that we're investing and diversifying in other areas, because this is really looking at U.S. large cap stocks. Now, what we're looking at here, lots of data, but on the left-hand side, it shows U.S. economic expansions, and on the right side, it shows economic recessions and the length of them. So we're in a new economic expansion that went back to essentially post-COVID, and you can see here we're about 57 months into this. So traditionally we have really long recoveries, and so that's our expectation. And if you look here, just looking at the bull market, thinking it can last longer. So going back to 1926, bull markets tend to run about 55 months, which is just over 4 years. We are now about 26 months into this recovery. Now, remember, 2022 was a tough year, so this data is a little different. It's not the post-COVID recovery. It basically shows, because we had a negative year in the markets in 2022, the recovery from those lows. And then you can see, and then also, you take the duration of how long a bull market could last, and then also what the median recovery is. And so we tend to have, quite strong gains coming out of bear markets or markets that had a negative year. And you can see the median is about 200% recovery, and we've seen about a 74% recovery. So we still think there could still be some room to run here for the current market. Now, when we get back to all of this, at the end of the day, we don't have a crystal ball, and we don't make decisions based on, especially short-term decisions, based on what we forecast for the markets. Our decision making is grounded in long-term financial planning, long-term investment management. I've talked before about you want to be an investor, but these are the key things that you have to do if you're going to be an investor. Is you have to rebalance portfolios. So it's natural that portfolios will get out of alignment. So we have to rebalance them. That's number one. Number two, balance between growth and value, between large cap and small and mid cap, between US and international. Now you have to find the appropriate balance, and that's what we strive to do for the portfolios, but it's important to have the balance. Because at the end of the day, if you get parts of the markets that have elevated valuations, by rebalancing, that gets things back into target and potentially allows you to sell things that are expensive and buy things that are cheap. And then, I think for this year, and frankly, I think I just expect this all the time, is we need to expect volatility. Market valuations are a little stretched. We definitely have geopolitical risk with a new presidency coming in and new policies, and I'm going to spend some time on that. But that's just something that, as investors, we have to embrace volatility, understand that it's part of being an investor, and not look at it as a negative thing, because it's going to happen every year. It's happened forever, and that trend will continue. Okay, the next topic we're going to talk about is bonds or fixed income and cash equivalents. So one of the things we look at the bond market. The bond market had a poor year last year, and especially in light of, you could get money market rates in the 4.5% to 5% range. You can see on here in the black box, it shows that the bond market, as measured by the aggregate bond index, only made 1.3% last year. One of the big factors of why that happened is that even though the Fed started to cut rates slightly, we did see longer term bonds yields went up, which caused pricing to go down. So not a negative year, but certainly a poor year. And if you look on this chart, if you can see in the bottom left, it shows the bear market, which was 2022. That was a really bad year for the bond market, down over 13%. So I think a lot of people were expecting returns to be a lot stronger on a go-forward basis. And, we do think last year was probably a little bit of an anomaly with rates going up, and we think that they're going to stabilize here, and we think bond returns are going to improve. And it's hard to pinpoint exactly when, but we think the returns, when we look back 5 years from now, will be solid and likely above cash yields. So one of the reasons why I think we discuss this with clients as well as other advisors, should we be leaving more money in cash? Because frankly, cash returns in money markets and things like that, cash equivalents are quite attractive. And so the concern that we have is that if you're investing right now for the short term and you're getting in the 4% range, the concern is, well, what happens if the Federal Reserve continues to cut and rates get down to 3 or 2.5 or lower? And the fear is that if we just sit in money market accounts, you're going to lose an opportunity to lock in some higher yields. And so that's the reason why we would want to look at bonds as part of the portfolio, to add some duration so that we actually get exposure to parts of the markets that aren't just aren't cash equivalents. And if you look here, the reason why we are concerned is, if you notice, these are just a couple quick examples. And in March of 2001, looking at how quickly the money market returns fell, from and only in like essentially 1 year, a massive change. And then if you see what happened in October of 2007, over a period of about a year and a half, how quickly cash yields fall. So I think that's one of the struggles that we have as investors is we look at current cash yields, money markets, T-bills look really attractive, but are we looking at it just for this year? Or are we trying to take a longer term approach and make sure that we view cash for the purpose of being in cash, and then we view bonds as a way to diversify, not just in the short term, but longer term. And that's definitely our approach. Municipal finance. And so this doesn't apply to retirement accounts. Municipal bonds they apply to taxable accounts. And there's a lot of data on here. So I think the thing to focus on here is on the left-hand side. It basically says municipal tax equivalent and treasury yield curves. So one of the reasons why municipal bonds can be attractive, they are federally tax-free, and if you buy them, bonds issued by your state, and you're in a high tax state like California, you will get not only you'll get state and local taxes free as well. So if you look at the yield curve on here, the bottom shows U.S. Treasury. Let's just focus maybe because it's easy to see. If you buy a 20-year Treasury right now, you're yielding about 4.9%, which is attractive. The taxable equivalent of a AAA muni is around 6%, and a triple B muni at 7.5%. So this basically shows us is that on a tax-adjusted basis, municipal bonds look very attractive. And so we do think these should be part of the portfolio. And even on the shorter term, when we're looking at things that are 3 months or 1 year, there's still some really attractive options for you as an investor. Now, this is one of these charts that has a lot of data on here, but is quite simple. So all these scatter plots basically show us where the current yield is on a bond portfolio, and then what the basically the forward 5-year returns. One of the things about stocks is we don't know what the returns are going to be 1 year, 3 year, 5 year, 10 year. We have averages, but we don't really know. When it comes to fixed income or bonds, there's a really high correlation around what the current yield is and what the returns over the next 5 years will be. And you can see how tight this range is on this line that is charted. You don't see that in the stock market. The stock market tends to bounce all over the place, but bonds tend to be far more predictable. And so you can see our expectation is that, right now the current yield is 4.91%. So this does imply a return of around 5% over the next 5 years. So there's a high correlation there. And, one of the things that we also want to make sure we're thinking about is, when we invest in real estate or stocks or other assets, there's an inherent level of risk there. Bonds have more predictability. Now, they do have inflation risk in some other areas, but they have more predictability as a stabilizing force in the portfolio. So even though fixed income returns were not great last year, by having a diversified portfolio with equities, generated a pretty healthy total return from a diversification perspective. Okay, our next topic, we're going to jump into some economic updates and really talk about some high level. Our favorite topic is some high level items around federal finances and consumer finances. So lots going on this chart. We're going to start on the left-hand side. In 2025, this is our projected federal budget in terms of where we're going to be spending money. And if you look at the bottom, working your way up, we have net interest costs, Social Security, Medicare, Medicaid, other mandatory spending, defense, and non-defense. Then you can see this on the right-hand side shows the source of financing, from income taxes to payroll taxes. Then it shows the deficits. And so you can see here we're projecting a massive deficit, which we all know. This is definitely the hot topic. And the reality is, I know that the new administration, their goal is to really get deficits down. It's going to be interesting to see how we tackle it. Do we tackle it only through cost cutting? Do we tackle it through deregulation that unleashes growth, and then more growth generates more tax revenue? So it will be interesting to see how this unfolds. This is going to be a massive topic of that we're going to be witnessing here for the next 4 years, and frankly forever. But this is a big issue. I think we do have to get the deficit issue fixed, at least under control. Continuing to borrow this kind of money is obviously not in the best interest of Americans, because we're just kicking the can down the road. So making some decisions today to start to deal with this is going to be very important. So when we look on the right-hand side, I pulled up these red boxes, and this basically shows the federal deficit and the net interest outlay. So what's the projection in terms of what's our forecast? So we're still projecting a deficit. We haven't got into a surplus. You can see on that chart, it does show a surplus basically in the late 90s. And then down on the bottom right-hand side, it shows the net debt, the accumulation of all the debt, where we are, as a percentage of GDP and where we're forecasted. And so the important things to take out of there is if the Tax Cuts and Job Act gets extended, otherwise known as the Trump tax cuts, if that gets extended, it's showing that the budget deficit's going to grow by 2034 pretty substantially, based on if it sunsets. By 2034, the deficits won't be as bad. So the reality is, this is going to be a hot topic for the executive branch, as well as both the Senate and the House, in terms of figuring out how we're going to navigate this and try to get our deficits under control. So it's going to be a big topic of discussion, lots of fighting going on. So plan on that. But at the end of the day, the reality is we do need to get this under control. We've been in a strong economy for many years, and it's important that when you have a strong economy with healthy growth, that you get your deficit spending under control. Because if you have a bad economy, that's when you need to have those additional resources to help stabilize the economy. And so right now, we in my opinion, I do think we need to get more focused on getting the debt under control, balancing the budget, cutting costs. And if you look at this, I mean, there's going to have to be some reform at the Social Security and Medicare level. Nobody wants to discuss it, but that's certainly something that has to be revised. Okay, consumer finances. And so on the flip side of this, when you look at the assets and liabilities of the consumer, we're sitting on 190 trillion of assets when we look at financial assets, pensions, homes, and then you look at our liabilities, 21 trillion. So talk about the U.S. consumer is really healthy. And when you look at one of the tells around how healthy are they is household debt service ratio. So the debt payments is a percentage of your disposable personal income. And you can see we're at really low levels right now. We're at roughly 11%. So we're at a healthy place. You can see in the fourth quarter of 2007, which is right before the financial crisis, that number got up to almost 16%. So we're in a great position here. So the U.S. consumer is extremely healthy. So that is definitely going to be a good tailwind for the economy. And that is something that we should be leaning on as a source of optimism. Next, we're going to transition and discuss the Fed, which primarily is going to be focusing on inflation and interest rates. So the reality is we are starting to see inflation stabilize. On this chart, we have this light gray, which shows that we're seeing year-over-year inflation decrease, and we're noticing that in the headlines, right? The blue represents the inflation that is cumulative, and it's measured by CPI. But basically, what this shows is that the year-over-year might be stabilizing, which is healthy. The reality is that since early 2020, the CPI is up about 22%. So because of the big jumps in inflation that we saw from 20 to the end of 22, even though we're seeing slower inflations, we're still at a much higher level, and that is still impacting a lot of consumers. Now, the trend is definitely going in the right direction. This is clearly a mandate for the Fed, trying to make sure that they make good decisions around what to do with interest rate policy. But the reality is these higher costs are definitely impacting consumers, especially on the margins, those that are living paycheck to paycheck. We do continue to think inflation is going to come down. We think AI, robotics, automation is going to continue to drive inflation down. It's also going to need to be paired with good economic policy. So depending on how the government decides to spend money and drive deregulation, there's going to be a lot of factors that will impact inflation. But generally, we're definitely in the camp that inflation is going to be more under control than not. Now, this just shows history going back to where interest rates have been going back to 1993. So you can see this big mountain chart of Fed funds rate up and down, up and down. So on the far right-hand side, this is where we want to focus now. You can see rates, from post-COVID all the way up till a year ago. We got rates, the Fed funds rate up to a little bit over 5%. That has now started to trend down. And then you can see all these forecast market expectations. The FOMC, which is the Federal Reserve Open Market Committee, their long-term projection is to get the Fed funds rate around 3%. So we're elevated from there. Market expectations don't think that the rates are going to come down as quickly, but that we're going to be generally in this area between 3 and 4%, which, based on those rates historically, those are within a good range of the economy being able to succeed and do well. So we do think rates are going to trend down, but I don't know if we're going to see them like come down quickly, barring something breaking in the economy. Now we're going to move on to the importance of diversification. And I know this term is used a lot, and I think coming off of some really strong stock market years, it's really important to keep this in mind, because I think generally when markets are doing well, people tend to underemphasize diversification. When markets are doing poorly, people overemphasize it or maybe use it appropriately. So I think the importance of diversification is something that I want to spend some time on today, just so that we understand what that means, and I'm going to go through a lot of historical data to make my case for why diversification is so important. So when we look at the S&P 500, obviously that's an index of the top 500 largest 500 companies in the U.S. And what we are seeing is the top 10 companies, the Mag 7 and some others, currently represent, in the top right hand side, you can see over 38% of the total market. So only 10 companies represent 38% of the market cap. And what that basically is showing us is that we have this concentration risk where the other 490 companies, the returns have been fairly muted, and the returns have been really strong in these top 10. So the question becomes: can the S&P, can these top 10 companies continue to drive us? And so what we are seeing is that investors really love these big names because they're familiar with them, but at some point these companies do get a little bit too expensive, meaning they have elevated valuations. And all elevated valuations means is that returns on a go-forward basis will be somewhat muted because of that. When we then get into market valuations, lots going on here. The 10-year annualized return, just wanted to share a little bit with you here in this red box. Large growth has been the best performer, 16.8% per year. And then if you look at small value, 7.1%. So for the last 10 years, all the parts of the markets have done great. Being diversified has served you well. And then the question becomes, okay, on a go-forward basis, where will some of the best opportunities be? When we do look at valuations, you can see that in the bottom right, it shows current PE as a percentage of the 20-year average. So basically, where's the market valued relative to its historic average? You can see large growth, which has been the best performer, is about 150% of normal, and then small value is about 100%. So this shows you across the board, valuations are stretched based on 20-year data. That doesn't mean things have to go down, but it just means we have to be a little bit more cautious. Now, if we go back in history, we had periods like the late 90s where this data looked very similar in 97, and then 98, 99 were blockbuster years for the markets. So sometimes, even though we're in periods of extended valuations, these things can continue on for multiple years, which is why we don't employ an approach to diversification that bets on jumping around, trying to find the best place to invest. We believe in broad diversification with rebalancing. So we want to maintain exposure to all parts of the market. We do it responsibly, and then as things get a little bit overvalued, we take some profits, and that's really the approach that one should take. Okay, so when we look at value versus growth, right? These are two different parts of the market. Value tends to be, I guess, in our current world, we're looking at financials, industrials, materials, and then growth tends to be more tech and healthcare. And if you look here, there's lots going on, but basically what I highlighted here is these red circles shows that right now value is cheap relative to growth. And you can see back in the bottom left there, that was back in 99, right before the dot-com bubble. You can see value was really, really cheap relative to growth. And frankly, on a go-forward basis, value outperformed growth pretty substantially for the decade following. So this is a good reminder. We're not at that extreme of evaluation, but it's just a reason why maintained diversification really makes sense. The chart on the right-hand side just shows, how does value versus growth do in different interest rate environments. On the far right-hand side, you can see this shows that when interest rates are between 4% and 5%, and then greater than 5%, that value tends to have some better performance relative, and growth does really well when interest rates are extremely low. And you can see that's represented on the left side of that chart. Asset class returns, like my favorite one here. One of my favorite charts. You can't read it though, right? There's a lot going on here. So what this basically shows us is that, when we go back, this represents back to 2010. So we're looking at 15 years of data. And on the far left-hand side, it shows annualized returns, and then it shows, I think this is measured by volatility. And then it shows all of the calendar year returns. So what's interesting on this, as you can see, annualized returns, large caps have outperformed small. Those outperform real estate. And then you can see asset allocation, which means being diversified. Volatility, small cap tends to be more volatile. And then you can see all the calendar returns. And so on the beginning of this 15-year period, look at the very top. It's REITs, Real Estate Investment Trust, did the best. They had the highest return for 5 of those 6 years. And then on the far right-hand side, we're looking at large cap growth, really, over these last 5 years were really stellar performers. The reality is, when we look at this from an asset allocation perspective, we like the idea of, we want to get strong returns, and we don't need to be the high. We definitely don't want to be the low, but that's why we build a diversified portfolio, because nobody can predict what's going to be the best performer in any one given year. And that's where diversification really comes into play. This is just a reminder of the importance of rebalancing. So a portfolio that is left by itself, meaning with actually no management, this is what happens. So if you start off with a risk tolerance that says, I want to be in a 60-40 portfolio, so 60% in equity and 40% in fixed, what happens over a period of, let's call this 6 years, back to 2019? So if you built the portfolio that had 40% in fixed and 10% international and 25% US growth and 25% US value, right? A pretty balanced portfolio. Throughout the years, you have different types of returns in these different asset classes. And so now the current allocation where you would be is you would have 27% in fixed income, a massive drop. You would have roughly the same in international, and then look at your U.S. growth holding has grown from 25% to 37%, so substantially more. So the point of rebalancing is that the idea is if you set your allocation strategy based on your risk tolerance, based on your financial goals, as things drift, you want to be making these changes. Generally, an annual rebalancing makes sense. We use annual as a baseline, but when there's periods of higher volatility, we tend to rebalance a little bit more frequently. And it just depends. There's times where we have really quiet years depending on the volatility. But this is just a good visual that shows a portfolio left unattended without any systematic rebalancing will get out of alignment. And again, the reason why that's important is if your risk tolerance says I should have 40% in fixed income and you are now sitting at 27, you're taking on more risk than you initially thought. Now, you've seen this chart before. So this is a diversified portfolio, can work even though it never feels good. So there's a lot of numbers on here. So it says the years, the S&P 500, and a diversified portfolio. And you can see the notes on what defines a diversified portfolio. And the reason I'm showing this is more the emotions around investing, right? So you can see all the emotions, how people feel. So I lost money, diversification worked, I lost money, I didn't make as much, I lost money, I didn't make as much, right? Back and forth. So at the end of the day, when you look at these periods of time, if you're using just the S&P 500, when you have great stock market years, you're going to feel like you didn't make as much. And then when they both have bad years, you're like, oh, I lost money, right? So it's this emotional entangling. And at the end of the day, when you look at the S&P versus a diversified portfolio over 20 plus years, the returns were almost identical over that period of time, even though the path to get there was quite different. So the next topic we're going to jump into is looking at the U.S. equity markets versus international. This is definitely going to have a little bit more focus on international because we spend most of our time thinking about the U.S. markets. A big driver of outperformance in the U.S. has been the dollar strength. So if you look at this chart, this goes back to 1999. And then most importantly, when you look at this, kind of the depths of the financial crisis, seeing where the dollar was around 2008. You can see from 2008, when this dollar index, we've seen this massive rally to the upside. And what that means is that when the dollar strengthens, that means that your international investments are valued less, right? Because you invest internationally, they're not held in dollars. And so in a strengthening dollar environment, that does not bode well for your international investments. And one of the things, and so then when we look over the same period, this shouldn't surprise you, is as the dollar has strengthened, and this chart actually matches up perfectly, you can see in 2008, running all the way up till today, the U.S. market currently trades at over a 50% premium to the rest of the world. So they're trading at a premium to the rest of the world because the dollar is a lot stronger, and also people's expectation, the US has really done a much better job than the rest of the world. But we do know that these trends tend to ebb and flow, and that's where you get the benefits of diversification. So when we go back to 1982, the chart on the left, it shows you that was a period of time during the most of the 80s, and then you can see this is below the line. You can see around 2010. These are periods where non-U.S. stocks outperform U.S. stocks, and obviously we're living in a period right now where U.S. has outperformed. When we look at the right-hand side, it shows valuations. So at the end of the day, you can see the rest of the world is relatively inexpensive compared to the U.S. And it's, again, because the U.S. has done so much better. And the reality is these other parts of the world are unloved, which is represented in their stock prices. And then when we look at some of these long-term cycles, and so we've just lived through, again, this is the same period of time, 2008 till now, where we've had a massive outperformance when it comes to U.S. These trends don't last forever, and this is a chart going back to 1971 that shows there are definitely periods, and this is represented by the purple, where international can outperform. So again, maintaining that diversified approach is really important. Now, just to be aware, most of the portfolios, the U.S. makes up about 60% of the overall world markets. Most of our portfolios are around 70 to 75% U.S. So we still have a massive U.S. overweight, but we use international to add some diversification within the portfolio. And then when we get to valuations, right, lots on here. So we had this period of time in 2008, which was right before the U.S. had this massive run that we've seen, this massive outperformance. And that was a period of time where at the top of this chart, it shows you that the international was overvalued relative to the U.S. And now we've seen the flip side of this is now international is way undervalued. We haven't seen this level of undervaluation. By this measure, it claims that we're at basically a 38% discount to the S&P 500 if we look at the all-cap world index ex-US. And so this makes a ton of sense of like, okay, on the left-hand side of the first red box represents the period of time where international was doing better. It also means it was overvalued. And now on the flip side is true this past 15 years plus where US has really dominated. And now we're in a period where valuations really matter and valuations have improved. Okay, we're having a lot of conversations about valuation. So let's jump into what's happening currently. We're going to focus primarily on the U.S. markets, looking at current market valuations. Oh, lots of data here. So at the end of the day, equity returns on a go-forward basis, meaning in the future, are very much a byproduct of current valuations. So the left-hand chart shows returns based on a 1 year. You can see the scatter plot is it's pretty much all over the place, right? There's no consistency. They kind of follow this line, but at the end of the day, they don't really. So 1 year returns are not predictable. The chart on the right shows 5-year returns. And I know I showed this slide a little bit earlier, but this basically shows when you have periods of time. So what we're looking at here is on the bottom, it shows PE ratios or price to earnings ratios. And then on the left-hand side, it shows returns, return expectations over a 5-year basis. And this is averaged annualized returns. So where we are today in elevated valuations, it basically shows that we're on the low end of future returns on a go-forward basis. So this would basically suggest, just like the chart before, that with valuations where they are today, we probably have to be a little bit more particular about what we own. We can't just focus on U.S. large cap because that's what's driving this. And we do want to make sure we understand that returns over the next 5 years are going to be tougher to come by. When valuations drop, meaning you have a decline in the stock market, then what happens is this dot shifts over to the left. And that means inherently by having a decline in prices, that actually helps forward-looking returns. There's a little bit more information on the Mag 7, probably maybe a little bit too much to go through. But basically, if you can see some of the numbers on here, the green represents the Mag 7. Last year, they generated 55% of the returns on the S&P 500. So if you were not allocated appropriately to them, you would have missed out on a lot of returns. So the S&P was up, we had measured about 25%. The Magnificent Seven as a whole were up 48%. So massive returns. In 2023, it was very similar, where the Mag 7 were up around 76%, and the S&P X Mag 7 were only up 8. So the reason why this is occurring is because their profits have been really strong. You can see in the bottom right profit margins. The Mag 7 represents, we've had much higher profit margins than the rest of the market. And at the end of the day, when we have good earnings growth, good margins, that represents healthy movements in those stocks, which we've seen. All right, the next topic we're going to jump into is just going through some economic and investing themes for 2025. So clearly, the big headline we have is the Trump economic agenda. So what we're seeing on this is there are going to be three main pillars: deregulation, tariffs, and taxes. And how this unfolds, obviously, every week is going to change. There's already been a lot of executive actions. So this is already occurring, but these are definitely going to be the themes. And the idea here is if we can get deregulation right, we can unleash the economy. If we can get tariffs, we'll level the playing field, or at least maybe the threat of tariffs level the playing field to focus more on U.S. jobs, U.S. manufacturing. And then taxes, if we make sure we extend current tax policies, then we can be in a tax favorable environment to drive growth. So the devils are definitely going to be in the detail on how this gets executed, but it's definitely going to be the theme that we're going to see, especially over the next 2 years, while the Trump White House has control of both the House and the Senate. And so there's going to be a lot of changes here, because I do think that there's going to be a massive push to shrink the government and go into a more deregulatory environment, which, depending on what side of the aisle you sit on, you can say this is fantastic or it scares you a little bit. And the reality is there's going to be mistakes. This is not going to be perfect. Anytime you're trying to make this massive of a change with the size of the economy that we have, there's going to be some things that we're going to look back and be, man, that was fantastic. And there's going to be things that we look back as that was a disaster. And so we'll see. Collectively, I'm optimistic that there's going to be a lot of good that's going to come out of this. But it's going to be a lot of hard work. It's definitely not as easy as I think that maybe we would like it to be. And so hopefully we'll be able to look back here in the next couple of years saying, all right, these policies were able to move us forward as an economy. One of the things I found this article in the Wall Street Journal, just says "Make America Cheap Again." Basically, is talking about the stock market. It looks a little bit overvalued. So it basically uses the Shiller price to earnings ratio and shows that where Trump is, Trump 2, where he basically is at 37 times forward earnings, that it's the most expensive level of any presidency's had at the start of their presidency, more than Biden, more than Trump 1, and then you can see some of these others on here. And then based on some of this data, what they're projecting is that it's going to be hard for returns to be very strong. Now, I will tell you, take this with a grain of salt. This is data put out by GMO. They tend to be really bearish and pessimistic. So this was in the journal, but I also read their stuff, and they tend to be really, really bearish and unfortunately not right all the time. So I just wanted to show you that the reality is, because the markets are really optimistic, when you're starting from these higher price points, returns definitely will be muted on a go-forward basis because of how expensive things are today. Tariffs on imports. So I didn't really know a lot on what our tariff history was. And so this chart goes back to 1930. So this shows on the left-hand side is basically, the percentage of duties collected based on the size of the economy. And then it shows all the years, almost going back 100 years. So the proposed, tariff levels, you can see on the right-hand side is, showing up in the double-digit area, between 15 to 18%. You can see the historical. We've had really low tariffs. We did have some tariffs. You can see where it bumped up. So we'll see how this plays out. I'm of the opinion that we're definitely going to be putting some tariffs on those countries that are not playing fairly. I do think we're going to probably use this as a tactic to change some of our trade policies to get a little bit more equilibrium. But again, getting back to my earlier theme, I definitely think there's going to be tariff policies that are going to prove to be great, and those that are going to prove to be a mistake and actually harm the U.S. economy. So I think it's going to be a combination of both. Hopefully we'll be able to navigate through that and be able to make changes quickly, so when things aren't working that we can adjust. But again, the size of the U.S. economy, that can be challenging just because of the sheer size of goods that are distributed on a daily, monthly, and annual basis. Labor supply. So what we have seen here is basically, we had massive payroll gains coming out of COVID. Now, the payroll gains month over month changes have really slowed. We have some big challenges right now. So we don't have, our population growth is not enough to really give us a real vibrant labor market. And with dealing with immigration, it'll be interesting to see. Obviously, there's the massive move to remove illegal immigrants from the country. The other side of this is I wonder if we're going to have a policy in place to encourage more legal immigration. Because when you look at our data, unless we're all ready to just have robots do everything, which maybe that's a 10 to 15 year prospect. But the reality is we're going to need, because we have such low population growth, in order to keep our economy moving forward, we're going to need to have a much more robust legal immigration process. And we're going to need to, in my opinion, I think bring a lot, make it available to maybe double and triple the amount of people that we allow to work here and to move here. Because if you look at the data on the top right, we just don't have it. The lack of population growth will definitely curb the growth in the economy because we're not going to have enough workers. The next slide here is we have this idea around tech-driven capital spending. So we all hear about all the spending that's going on with AI. So this represents spending that's coming from Alphabet, Amazon, Meta, Microsoft, and Oracle. You can see the amount of CapEx that's going into AI is massive. I mean, just look at these numbers from back 10 years ago. We're looking at spending in the 30 to 40 billion dollar range, and now we're projecting 200 billion and pushing up closer to 250 billion. So massive amounts of spending that is going to go in to really drive AI. There's going to be lots of benefactors of that. One of the things that'll be interesting, and I think this is going to be a little bit of the challenge, is that oftentimes when you see these major spending campaigns, is like, are these sustainable? Are they one time? How long will this last? When you look back at the data from like the .com bubble, we were having a massive build out of the internet and telecommunications, and if you remember Y2K, so preparing for the year 2000, we had all this spending that got pulled into like 1998, 1999, and so it'll be interesting to see is this capital spending sustainable, or is it just front loading all the spend because these big AI hyperscalers are trying to stay competitive? So that's where I think we have to be a little bit cautious. That's where I think it also is going to behoove us to continue to diversify, because there's a lot of excitement around these areas, but at some point valuations get stretched if revenues don't keep pace, because if the spending doesn't maintain this rate of growth, then that will definitely hurt earnings of some of these major companies. Electricity consumption. I don't know if I've had this slide up ever before, because the reality is our U.S. The chart on the left shows you our U.S. electricity consumption growth. We've been in a long-term decline, right? And so you can see just the way, I think with energy efficiency, we've just been in a massive decline there. And over this last several years, because of the demand for the data center side of things, is really pushed up energy demand and consumption. So on the top right-hand side, it shows like data center expected growth in electricity demand. And this is one of the reasons why you're seeing, I think it was Amazon is having a deal with 3 Mile Island to have the nuclear reactor back online to produce energy. So we definitely think this is going to be a big theme, electricity consumption, and where we're going to get our sources of energy, whether it's from nuclear, more solar. Definitely going to be a big theme for the next several years as we try to compete. The reality is when you look at some of the data, how expensive it is for us to produce energy relative to, let's say, China. We're far behind there. And if we're going to truly be dominant and maintain our dominance, we're going to need to bring the cost of energy down. So this is going to be a big theme, and hopefully with renewable or cleaner energy sources. And then the bottom right, it just shows you, based on where we're trying to go from an electric vehicle perspective, the amount of charging points that we're going to have, is absurdly high. I don't know if we're going to be able to hit those numbers. I do have a Tesla, but the infrastructure in Los Angeles is not bad, but around the world, there's definitely going to be a lot more construction and build out that's going to be necessary. But again, this is just going to put a bigger strain on our grid. So we're going to be moving into a time where we're going to have to update our grid basically to accommodate this, and that's going to be a massive amount of spend here over the next 10 years. This is a slide a little bit off topic, but it just goes into gold versus Bitcoin ownership. So one of the things is you're definitely seeing, cryptocurrencies, Bitcoin become more mainstream. That's definitely been a theme with Trump, trying to decide, okay, are we going to have strategic reserves in Bitcoin? Should we have it? This just represents like a breakdown between gold and Bitcoin. And the reason why this slide is relevant is that a lot of times you'll hear people talk about Bitcoin as the digital gold, and like Ethereum is like the digital silver. So that's why I wanted to show you on here is like, okay, well, who owns these things, right? So you can see gold is represented in blue, and then the gray is represented is Bitcoin. So you can see private holders, clearly Bitcoin has the advantage there. Industrial uses, jewelry, there is none for Bitcoin. What's interesting is you can have, as you work your way all the way down to where it says governments and funds and ETFs. And so governments have about, a little bit over 13% in gold, about 2.6% in government. You can see funds and ETFs, a lot more exposure now to Bitcoin, and that part has been growing because a year ago, essentially it was non-existent. So we're definitely going to, that could just drive demand. A lot of times we'll get the question as, well, what's the value of Bitcoin? And it's just a supply demand issue, and it's a scarcity issue. And so we're definitely seeing that this is more part of diversified portfolios where, we're considering like 1% to 3%, depending on your risk tolerance. Definitely something that we're open to having a conversation with all of our clients. But this is the reality of what we're starting to see, and there's likely going to be more companies and governments that own Bitcoin as a way to hold some of their cash reserves. The other thing is when we start looking at, I know it feels like we're almost a little bit in an environment where we're dealing with protectionism, especially when you talk about tariffs. And the reality is, we have a massive global technology supply chain in terms of where things are made. So if you look here on the left-hand side, it goes through the semiconductor production by location, right? So the chart starts in 1990. So back in 1990, look at where US was, 37% of the market. Europe was 44%. Look where we are today. US is 14, Europe is 9. China went from essentially 0 to 21. Taiwan essentially went from 0 to 17. South Korea essentially went from 0 to 19%, right? So we have a massive amount of reliance on a global supply chain, which could put us at risk if we can't produce our own. We are seeing a lot more push to bring back domestic production of semiconductors, and I definitely think it's because of a chart like this. And then when we look at the right-hand side, in order to properly build a lot of the next gen technology around semiconductors, even batteries, we need to have a reliable source of different mining, basically products, rare earth minerals, lithium, copper, and you can see, U.S. is definitely not at the top of the list on a lot of these, and so this could put us at a disadvantage. And so this is going to be where we kind of flex our muscle around the world. Is going to be in these areas where we have a reliance on these commodities. And we're not a big producer, which obviously is something that I think that this administration is going to be paying a lot of attention to. Okay, as we're getting near the end today, so we have this idea of investing at all-time highs. All the time I get, the markets keep hitting all-time highs. Is now a good time to invest? And we do look at your investing habits should be based on your financial goals. And generally, the best time to invest is when you have the money to invest. And what this basically shows on the left-hand side is the number of all-time highs last year. There was 57. And it also shows the percentage of these all-time highs that act as a floor. So it's 31%. So you're hitting all-time highs, but the reality is markets keep moving higher. We're not retesting. We're moving to new highs. And the reason why this is significant is generally prices of real estate, prices of stocks over time go higher. We live in a dynamic economy where that's just because we have inflation built in. We have companies that are producing more. That's just generally the trend that we see, and it's continued to we've continued to be able to do this over time. Now there are periods where we don't hit all-time highs. We go through sideways markets that can last decades, or I should say maybe a decade or 15 years. But when we start then looking at, okay, well, what does this mean for returns? And so on the right-hand side, it actually shows, okay, what if I just invested any day, or if I actually invested the all-time high? What this shows is that you can see on the 5-year basis, and actually in all periods, 3 months, 6 months, 1 year, 2 year, 3 year, and 5 year, that your returns on a cumulative basis were better just investing at a new high than investing on any day. which kind of shocked me. I thought that the data would suggest differently. So what this is just a reminder is you invest if the money comes in. We all know this. We're doing this with our 401k. We do recommend that you invest on an ongoing basis, dollar cost averaging in. Markets are designed to hit all-time new highs. The key is right now, we believe that we shouldn't be chasing the returns of everything that has been great over the last several years, is making sure as we're investing, as we're diversifying into those areas that maybe are falling a little bit behind and have greater value. And that would really definitely be our focus to maintain balance in a portfolio. Okay, as we wrap up today, hope you enjoyed this. If any of you listening to this are prospective clients and would like to have a 30-minute consultation with one of our wealth advisors, they are free. You can visit our site or you can scan this QR code and sign up. And we're happy to give you 30 minutes of our time to see if we can make an impact on your financial life. Thank you very much and have a great day and have a great year.